There's no doubt that our property markets are in a broad-based boom, with all segments, almost all segments other than the inner city apartment market, showing strong property price growth. And the media's having a field day. It's whipping up a frenzy of emotions, with headlines causing some buyers to worry that the housing market's running away from them. In fact, FOMO, fear of missing out, seems to be a common theme amongst most Australia's property markets. But the general media and certain commentators on social media, they're starting to worry home buyers and investors. They're speculating that interest rates are about to rise, or that unemployment's going to escalate to 8% when JobKeeper ends, or that everybody's moving to the country and city property values are going to be affected. So in today's show, I want to bust some media property myths, and I'm going to do it in two segments. Now, you probably know that I host a regular weekly Property Insider video on my YouTube channel, where Andrew Wilson and I have a talk about the property markets, and Andrew gives sensible, down-to-earth commentary about what's happening in our property markets. So today I want to share with you the audio recording of last week's video. That's going to be the main feature, but first I'd like to bust some of the media myths about regional Australia's property markets, about who's moving there and whether you should consider investing in regional Australia. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I'd like to start today's show by discussing the myth that's being promoted in the media that investing in regional Australia is a great idea. Now, firstly, that's a silly comment because there are so many different regional markets. Look, as you know, I don't suggest investing in the Sydney property market or the Brisbane property market because even within capital cities, or maybe especially in capital cities, there are so many different markets divided by geography, by price point, by type of dwelling. So therefore suggesting investing in regional Australia makes little sense because there are so many different parts of regional Australia. Then there's the argument that some put in the media that this particular town in regional Australia has performed better than the Sydney property market. While that's probably true, again, it's a silly comparison because the regional town may only have, 5, 10, 20,000 people in it, and Sydney has over 5 million people in it. Wouldn't a better comparison be the long-term performance of a particular regional town against a high-performing capital city suburb? Now, before I annoy too many people, let me say I love regional Australia. Pam and I often travel around Australia on vacation, and we enjoy meeting the people in regional Australia, learning from them, learning about our history, and enjoy what Australia has to offer. And I can understand why some people prefer living in regional Australia to the big smoke. But when it comes to investing, you shouldn't consider how you want to live. You should invest based on numbers, stats, demographics and evidence. And that's what I want to share with you, in just a moment. Now, what I'm going to talk with you about at the moment comes from a blog written recently by property commentator Michael Matusic, and he was discussing some of the myths about regional property Australia. Now, I'm going to include a link to that in the show notes, but I'd like to give him credit for some of the numbers and figures I'm going to be sharing with you. There's no doubt that there is a small move, a cohort of people who now want to live in regional towns. They want to be within commuting distance of the big capital cities because they've found they can work from home either part-time or full-time. But Michael Matusic asks, is that what's actually been driving our regional property markets? And Matusic suggests that the real reason why regions have increased in net internal migration over the last 12 months is not what most people think. It's not what the media says. It's in fact because people who'd normally have moved from the regions to the capital cities are, at the moment, staying put. Now that's an interesting thought, isn't it? But it's backed up by the Australian Bureau of Statistics, which suggests that this is true. Now, net internal migration to the regions in Australia last year was 36,500 people. And that's up 14,000 people, or 62% over the year before. So some commentators out there in the media are saying, see, people are moving to regional Australia. That's only 14,000 people more. If you take 3,000 from Melbourne, Sydney, Brisbane, it's not going to change the Melbourne, Sydney, Brisbane property markets, is it? But it may have an effect on a small regional town. Anyway, that figure, 14,000 more people, 36,000 people moving to 36,500 people moving to regional Australia, sounds impressive. But you know how numbers lie and how you can twist them to make your point. You see, net migration is worked out by comparing those that moved into an area against those that leave the same place during the same time frame. And in the chart in Michael Matusik's blog, which I'm going to put a link in the show notes, he shows the numbers clearly. But I'll try and explain it in words because obviously I can't show you the charts in this podcast. Firstly, the overall level of arrivals to and departures from regional Australia has actually fallen over the last 12 months. I know this is partly because there's no overseas immigrants coming to Australia, and this impacts both capital cities but also regional Australia. Secondly, the Australian Bureau of Statistics figures show that there's been little change in the number of people moving from the capital cities to the regions. Let me repeat that. The latest stats show there has been little change in the number of people moving from the capital cities to the regions. While on the other hand, there's been a big increase in the number of regional residents who haven't moved to the bigger smoke. And of course, this trend has increased during 2020 as certain states have implemented increasingly strict COVID-related lockdowns and other restrictions. So let me share some other thoughts with you if you're even thinking of investing in regional Australia. Now remember, my property strategy is to invest in high growth properties that are going to grow and build your asset base and over time increase in rental income so that you can eventually live off your rental income. So we're looking for areas where wages are going to go up, where people are going to be able to pay more for their properties and pay more rent to you, because your future income is going to be dependent upon your tenant's ability to keep paying rent. Now, having said that, around 70% of Australians live in our 6 main capital cities. And I don't think this is going to change because of the pandemic. In short, capital cities are where the jobs are, where the services are, where people want to be located. Now, the majority of higher-paying jobs that are going to be created in the future, they're going to remain in the capital cities, and let's be blunt, they're going to remain in the big 3 capital cities, Melbourne, Sydney and Brisbane, and that's what's going to drive future property value growth and rental growth, because wages aren't going to go up that much in general, but knowledge workers and certain higher-paid jobs, they're going to be able to afford more, either to buy properties, pushing up values, or pay rent to you. And that's where we want to own our investment properties, isn't it? So, in short, the jobs, the higher paying jobs that are going to be created are going to be in the capital cities. Now, if you think about it, most young people don't want to move to regional Australia. That's not where the action is for them. There are fewer higher paying job opportunities, and there are few opportunities to meet life partners. At the other end of the scale, while baby boomers are keen to improve their lifestyle, most don't want to move to regional Australia. They want to be where their children are, where their grandchildren are, where their friends are. On the other hand, people living in regional Australia, they're keen to move to the capital cities. Now, many regional residents have put their moves to the capital cities on hold last year, and as a result, I believe we're going to see a big snapback to positive net migration to the capitals once the COVID vaccine rolls out and travel-related restrictions are ceased. Now, unless major money is spent on regional infrastructure, and this amount rivals the amount spent in the capitals, any major significant population move to regional Australia isn't going to happen. The changes are going to be modest at best. Now, Michael Matusik puts it very well when he says, despite recent weasel words suggesting otherwise, the decision makers must think this too. In other words, that they're not going to make changes unless they put big money into infrastructure. Matusik goes on to say, ask yourself, if we are truly going to see a regional resurgence, then why is almost all the existing and the proposed infrastructure projects focused on the major capital cities and mainly in the inner city areas within those cities? Well said, Michael Matusik. So don't believe this media myth that investing in regional Australia is the right thing to do. Think about it. If your investment budget's limited, and look, that may mean you can only in your lifetime buy 2, 3, 4 investment properties, you need to buy high growth properties initially in areas that are going to be where the demographics are going to be able to afford to pay more, to buy properties, to rent more in the long term. So why fight the big trends? In a moment, I'm also going to play an audio of last week's Property Insider video. I mentioned that a minute ago to you in my introduction, in the chat I had with Dr. Andrew Wilson, Australia's leading housing economist, where we're going to debunk a number of other media myths. That about rising interest rates. And we're going to talk a bit about what's happening to the economy and answer a question left by somebody who watches our regular videos. But before I do that, I just want to explain to you that if you are considering investing, and there are some great opportunities at the moment, you can't just buy any property, whether it's in the capital city or in regional Australia. Because if history repeats itself, and it surely will, most property investors are going to get it wrong. Look, we know that during the boom last time round and the time before, despite property values increasing significantly, more than half the people who got into property had to sell up after 3, 4, 5 years, and others actually just got stuck owning the wrong properties. So, as I said, not all properties are going to increase in value, so now more than ever, correct property selection will be critical. And if you're not sure where to start, why not have a chat with my team at Metropole to provide you with direction, guidance and results? Now, our research department has statistics on every property market in Australia going back 40 years. So we know what apartments and houses have done in every suburb of Australia, including regional Australia. So we base our suggestions and recommendations on facts. We've got no properties for sale. But having said that, before you start, we put together a strategic plan for you. So whether you're a beginner or an experienced investor, why not have a chat with my team at Metropole? Hey, we won another international award last week. We were awarded Australia's #1 property investment consultants for 2021, another international award. We won 2 of those last year, and I'm proud of what our team's done. So we help you grow, protect and pass on your wealth. We give you some safety and security, and even in these times you need it. Go to metropole.com.au and find out more about what we do. And now, let's have a listen to the chat I recently had with Dr. Andrew Wilson. Fear of missing out, FOMO, seems to be a common theme around our Australian property markets at the moment. Auction clearance remain high, prices are continuing to rise, and supply remains constrained. And we're being played by the media. They're whipping up a frenzy with emotive headlines, causing some home buyers to worry the housing market's running away from them, while they worry others by speculating that interest rates are about to rise or that unemployment's going to escalate to 8% when JobKeeper ends. Now, the fact that we respond to these headlines, it's normal. After all, we're human, and the desire or the aspiration of buying your first home or upgrading your existing home or getting into the property investment ladder, look, that's normal. But let's bring some sense to this. So I'm looking forward to my discussion this week with Dr. Andrew Wilson, Australia's leading housing economist, to show us what's really happening in the property markets. Hi, Andrew.
Good morning, Michael. Yes, it's another day, another dollar with a commentary in the housing market. It's either a boom or a bust, let's face it.
Well, we'll unpack some of that as we go along. And our property markets, I guess, are in the midst of a broad-based boom. Housing values are continuing to rise in March. They're continuing on from the first couple of months of this year. But we keep mentioning at the beginning of each of these shows the good real-time indicator of how buyers and sellers are feeling, which is auction clearance rates. And they're continuing their record-breaking activity, aren't they?
Yes. Look, Michael, we've got to really state that these are unprecedented times. These auction market results on the weekend, and the main auction markets are Melbourne, Sydney, Brisbane, Adelaide and Canberra, they're all now recording extraordinary clearance rates, 80, 90%, weekend in and weekend out. We have never seen that before. And the Brisbane market particularly, I don't know what's happened to the Brisbane market, Michael, but we were used to saying that, oh, that's a good result when it was 55%. Now it's 85%. And It's just quite extraordinary. I think we are going to see record prices growth over the March quarter. I think one of the records that will be broken will be if we look at the national average of prices growth for each of the capital cities over the March quarter. I think that will be a record result. And normally national house prices are based on the volume per market. So obviously Melbourne and Sydney with more sales dominate in terms of that so-called national price. Of course, and that's meaningless because if it's all Melbourne and Sydney, well, it's not really a national price, is it? It's downgrading what could be equally strong results in Hobart or Darwin. But I think that if we average it out rather than look at that weighted average based on observations, listings, we may see a record because there's so much consistency in this market now across the board.
You're right. Look, I've been following auctions. I've enjoyed the street theatre of auctions for close to 50 years now, and I have never seen it this way. But while our housing markets are very resilient and they've done well through COVID, now they're surging, the rental markets, well, they've been a bit fragmented, haven't they, Andrew?
Yes, Michael. The latest data from My Housing Market for February again shows a disparity between, as you suggested, between house rents and unit rents. My Housing Market produces vacancy rates for individual house and unit categories, unlike most of the other vacancy rate modelers. And we can see there that the high vacancy rates overall in Melbourne and Sydney are really a product of very, very high vacancy rates in units. And those high vacancy rates are certainly in the CBD areas. If we do separate those houses from units, Michael, we see it's actually quite tight for houses. If we look at the rental growth, we can see rental growth continuing for houses, but certainly on the slide for units. And again, when we look at where the rental weakness is, it is in those inner city CBD markets. Now, even though we did see a slight reduction in vacancy rates for units in Sydney and Melbourne over February, really it was only marginal. And it was a product of seasonal factors because in February, of course, we always have higher demand as the holiday period finishes and tenants start thinking about moving to new properties or else new tenants enter the market. But that's still very much a mixed bag, as you suggested, Michael. Tough for landlords in those CBD markets in Melbourne and Sydney, but a much better ride out there for houses, and vacancy rates are certainly tightening for houses and rents are rising.
Well, it's unlikely that those inner CBD high-rise tower apartments are going to start filling up until our international borders are open, students come back, Airbnb come into the market. But, Andrew, there was a lot of talk about a recession last year, and we talked about what was going to look like a V shape, a U shape, a Nike swipe. But last week's economic data showed our economy continues to rebound with the fourth quarter GDP beating most expectations. It rose by 3.1% over the quarter. And Andrew, this was driven by broad-based activity. It wasn't only consumers. I was interested to see businesses now back to investing in machinery and equipment, and government demands growing. So this is looking positive for our economy.
Well, yeah, it's really disappeared from the media lexicon, the word recession, hasn't it, Michael? In fact, if we remember our famous Prime Minister, Mr. Keating, when we had our previous recession in the early 90s, he famously was quoted as saying, this was the recession we had to have. I'm saying this is the recession we never had, because it wasn't really a recession, Michael. We had a very slight easing of economic activity over the March quarter last year, down by just 0.3%. And the economy up to then was a little mixed anyway. And then we had the coronavirus slide, and that was down over 7%. And then we've been back in town quite strong. We haven't quite made up what we lost in the March and June quarters, but we will certainly do that over the next quarterly data that we get. And, as I said, that it really hasn't been a recession at all, as we would, I guess, understand in classical terms. Yes, we had 2 quarters of consecutive economic growth, lower GDP, but really it was that black swan event just kicking the economy over the June quarter, and we've bounced back quite strongly, as you suggested.
Well, technically it was a recession, as you say, with the 2 quarters, but it was a recession the government made us have, and it quickly pulled us out of it. And one of the factors that people were talking about then was unemployment. It was going to get to 10% to 20%. And in my introduction, I mentioned how some media commentators are back at it again. They're worried unemployment's going to rise when JobKeeper ends. But recently, NAB and SEEK, the employment website, showed that there's been really strong growth in job ads. In other words, it's signalling that our labour market could tighten faster than many expected and unemployment could fall faster. But I just remember week after week, you've been suggesting that anyway.
Yes, well, again, a lot of those gobbledygook headline chasing negative job predictions. The cliff has also gone out of the lexicon of the media and commentators. I don't think they're expecting any noticeable change in the employment market after the end of JobKeeper at the end of March. And although, of course, it will have an impact, let's not downgrade that on some that have been using it to support their incomes. We've had the offset to that, which has been plenty of jobs being produced and aggregated incomes increasing as a result. So we've had a great run, Michael. The Australian economy has bounced back. I think that we will continue to see unemployment rates in the low sixes. And as we gather even more momentum, I think we'll move into the fives this year. And again, I guess there'll be another conversation around the prospects for the housing market and the labour market going forward. But it's been a very positive result out of the coronavirus shutdowns, both in terms of the labour market and our economic growth.
Well, while we're on to those things the media is scaring us about, it's worrying people suggesting that interest rates are going to rise.
Yes.
They've got to go up, Andrew, they say, because look at our booming housing market. What would you say to those people?
Well, why does it have to go up, Michael? Why does everything stay the same? We've never had interest rates this low, which is basically 0.1% official rate, which is zero. While we've had house prices at growth at this level, usually it's a sharp decline in interest rates that drives house prices at this level. But it's really the catch-up energy that's driving the market. And as you suggested, a lot of momentum, a lot of FOMO. Buyers are wanting to get in on the action, and most buyers are sellers and sellers are buyers. And the prospects for higher interest rates, you cannot make a case other than saying, well, it could happen, couldn't it? Well, anything could happen, couldn't it? Because logically, there is no economic case for higher interest rates in the foreseeable future. And the foreseeable future is as long as we can foresee. We had this, again, the speculation started to run because the chairman of the Fed last week, Mr. Powell, stated that his comments regarding the outlook for inflation were perceived as being indicating that perhaps inflation might start to rise over time. And of course, straight away, the market's hanging on to every little thread they can to try to, of course, the markets want to have some change because they can't make money unless there's a changing market. They need a margin. So long-term bonds started to increase because it was factored in that this meant that interest rates would rise over time. Let's be very clear. This is simple. And I speak to all the economists out here. Throw your textbooks away, especially your macroeconomic textbooks. Just stick to the micro. And microeconomics, the fundamental of all economics is the law of supply and demand. And until we have a significant excess of demand over supply, we will have no inflation in our economies. That's the bottom line. That's what we look for on the ground. Too much demand, not enough supply, pushing up prices, increasing inflation, and eventually resulting in higher interest rates. This conversation regarding higher interest rates is all about putting the cart before the horse. You won't get inflation or higher interest rates or higher long-term bond yields until you have an excess of demand over supply, Michael. I'm sorry to harangue you with this, but I think it's very important. And the point is that even with the Reserve Bank governor stating that we need to have an unemployment rate in the fours before he reckons that inflation will start rising and therefore followed by interest rates, we were having trouble with the low fives with getting inflation up and incomes growth up. There's no guarantee that even if we did get to a 4% unemployment rate, that we would have inflation and incomes growth occurring as a result. Again, we're looking backwards and pretending it's a magic pudding and everything stays the same. The US got into the 3%, Michael, with its unemployment rate and still couldn't generate any incomes or any inflation. So let's just Forget about higher interest rates. Let's turn the conversation into something a lot more rational, please. Although I think that we're stuck with this for the longer term, Michael, until it finally gets through that this is a completely different environment now that we are in.
The problem is people are listening to those experts on YouTube and experts on Facebook, and they're being a bit worried by them. Now, Andrew, our weekly Property Insider videos are being watched by thousands and thousands of people, and they actually attract a great deal of commentary. Some people agree with us. Clearly, some have a very opposite view. Now, that doesn't concern me because opposing views is what creates markets, isn't it? However, one regular viewer left a following question on YouTube. So I'd like your thoughts on a question left by somebody who calls himself just a middle-aged bloke. And he leaves comments every week. And he said, "Thank you for the fantastic comment. I was wondering if I could ask Dr. Wilson to explain to some common folk the mechanism behind which significantly rising sovereign bond yields could end up raising borrowing costs for consumers, the masses." He goes on to say, "After all, surely the big macro issues like these could potentially have a bigger impact on house prices as much as the impact of unemployment and the like." Now, you've partly answered that anyway, Andrew, but what would you say to just a middle-aged bloke?
Well, look, sovereign bonds are nothing to do with the macroeconomy per se. The macroeconomy is those issues of supply and demand. Now, bonds are just a reflection of what is happening in the macroeconomy. When people will buy a debenture and the rate of return on that debenture is based on the underlying rate of return in the economy. Now, if our economy is heating up, then interest rates will rise. Now, longer term bonds obviously tap into perceptions of what the market may be in the future. Now, as I said, that's all about perceptions, not reality. Reality now quite clearly is that there is no prospect of inflation, higher incomes, or higher inflation, higher incomes, and therefore higher interest rates until our economies at least pick themselves up off the floor. And that's why longer term bond rates will remain reasonably consistent. But they vary, Michael, as speculation moves in and out of the marketplace. And you've got to understand that traders are working on that speculation. Of course, other factors that create interest in sovereign bonds are the actual nature of the local sovereign economies. And we've seen quite a strong appetite, particularly for Australian government bonds, both at the Commonwealth and the state level, because our economy is doing well. But our interest rate differentials are not that significant. And that's all about a creditworthiness perception, Michael. But our interest rates are not that different from anywhere else in terms of those longer term rates, because we are a hostage to what the fundamentals are in our economy. And until we get more people in work and we get that increase in demand over supply consistently, pushing up prices, we can forget about any sense of a higher interest rate outcome. I hope that's explained that, Michael. It is, as I said, putting the cart before the horse to some degree. Let's look at what's happening now. It's just tea leaf reading to speculate that in 10 years' time we're going to have high interest rates and higher inflation. The GFC, Michael, is more than 10 years past, and we've created no inflation, no incomes growth in the last 12 years since then. That's all about the future, isn't it? And that's learning from the past. But it's a cheap headline, Michael, and it helps with arbitrage and all those traders that are looking for a margin. So just look at the fundamentals, Michael. That's my advice.
Well, I think that's what we have to go by, the fundamentals and evidence-based discussion rather than fear and speculation, which the media loves. And we understand it's not their job to educate us. It's their job to entertain us. It's their job to get our eyes onto their websites because they've already sold the space to advertisers. They've sold our time to them. So I look forward to having a regular chat with you each week and bringing some sense to the property markets and the economy. Thanks for your time, Andrew.
Thank you very much, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'd like to read to you an article written many, many decades ago by Jim Rohn, but some things just don't change. And his discussion was about facing the enemies within us. He was really talking about facing our fears. And today the world seems to be bringing on challenges, worries, fears from all directions, doesn't it? But Jim Rohn has got a great lesson for us, because he tells us we're not born with courage, but neither are we born with fear. He says maybe some of our fears are brought on by our experiences, by what somebody's told us about what we've read or heard. Some of our fears are valid, like walking alone in a bad part of town at 2 a.m. But once you learn to avoid that situation, you don't need to live in fear, do you? Says Jim Rohn. Fear, even the most basic ones, can totally destroy your ambitions. Fear can destroy your fortunes. Fear can destroy your relationships. Fear, if unchecked, can destroy our lives, said Jim Rohn. Fear is one of the many enemies lurking inside us. Let me tell you about 5 of the other enemies we face from within, said Jim Rohn. The first enemy that you've got to destroy before it destroys you is indifference, taught Jim Rohn. What a tragic disease this is. Oh, harm, I'll let it slide, I'll just drift along. Here's one problem with drifting. You can't drift your way to the top of the mountain. Now, the second enemy we face within, according to Jim Rohn, is the enemy of indecision. Indecision is the thief of opportunity, of enterprise, said Jim Rohn. It'll steal your chances for a better future. Take a sword to this enemy, said Jim Rohn. The third enemy inside us is doubt. Sure, there's room for healthy skepticism. You can't believe everything nowadays, can you? But also, you can't let doubt take over. Many people doubt the past, they doubt the future, they doubt each other, they doubt the government, they doubt the possibilities, they doubt the opportunities. Worst of all, they doubt themselves. Jim Rohn said, doubt will destroy your life and your chance to success. It'll empty both your bank account and your heart. He said, doubt's an enemy, go after it, get rid of it. The fourth enemy Jim Rohn warns us about is the enemy of worry. We've all got to worry sometimes. Just don't let it conquer you. Instead, just let it alarm you, said Jim Rohn. Worry can be useful. If you step off the curb in New York City and the taxi's coming, you've got something to worry about, said Jim Rohn. But you can't let worry loose like a mad dog that drives you into a small corner. Here's what you've got to do with your worries. You drive them into a small corner, said Jim Rohn. Whatever's out there to get you, you've got to get it. Whatever's pushing on you, you've got to push back. And the fifth enemy Jim Rohn wanted to warn us about is the enemy of over-caution. It's the timid approach to life, because timidity is not a virtue, it's an illness. If you let it go, it'll conquer you, according to Jim Rohn. Timid people don't get promoted, they don't advance and grow, they don't become powerful. You've got to avoid overcaution. Do battle with the enemy, do battle with your fears. So Jim Rohn teaches us to build your courage, to fight what's holding you back, what's keeping you from your goals and your dreams. He says be courageous in your life and in your pursuits of things, in pursuit of the things you want and becoming the person you want to become. Some great words of wisdom from one of my mentors, Jim Rohn. I hope you got some benefit learning about some of the things that I'm calling myths that the media is currently telling us. And if you did get some benefit and you know somebody who would also get some benefit, why not tell them about the Michael Yardney podcast? Use the share button on the podcast app or just talk to them about it in the good old-fashioned way, or you can leave a review and tell the world. And if I read it out, as I'm about to, for Mutha Mohammadis, if I read out your review and you email me michael@metropole.com.au, I'd love to say thank you by gifting you one of my books. Now, Mutha Mohammadis left this review on Apple Podcast. He said, "Hello, Michael. Glad that your podcast appeared in my Google search on investment-related topics. I'm now a regular listener to your podcast. I'm happy to hear your voice and the way you present information, especially, hey, in between that information. Very cool. Your topics enable in strong building foundations to beginning investors like me to achieve level 4 investor. Okay, I'm not sure I read that exactly right or the English was wrong, but it doesn't matter. I know I understand what you're saying, Mutha, which is nice. He said it's very motivating, inspiring, and he loves to hear it across multiple media platforms. May God bless you in all your endeavours and wishing you good health. Keep going. Best wishes, Mutha. Well, Mutha, thank you so much for those kind words. I really appreciate it. And again, if you make contact with me, michael@metropole.com.au, I'd like to say thank you by gifting you one of my books. I'll be back again real soon, twice a week. But in between these podcasts, you can catch me on social media. Just look for Michael Yardney. And if you want daily, short, sharp, exclusive information I don't give elsewhere, and usually it's related to having lots of charts and graphs as well, go to Facebook and join my Facebook private Facebook group. Go to Facebook and look for Property Update, the Property Update Facebook group, and I'd love to be part of your wealth creation journey. Catch up with you again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?